Okay, good to be with you folks. Let's go ahead and jump into things. Again, real quick, upcoming events. Remember, we do two types of events: an informal, what we call investments for breakfast. That's done here in the office in our conference room. We do that at 9 a.m. Every couple Tuesdays. The next one will be January 5th. And we also do formal seminars. We have two coming up in January, one on January 14th in Sun City Festival, and then again on January 28th, and that is in Sun City Grand. Would love to have you at any of those events. Just give us a call. Now, let's move on. Risk indicator. Notice where this thing is, and if you'll remember, over the last 2 weeks, we were further into the green zone, but with recent price action and with the big announcement this past week, the market has gotten pretty jittery here. In fact, it's pushed us to the edge of the yellow and green zone. And so this is going to be a pretty key week for us. So bottom line, as far as our allocations, we're still on the bullish side, and we're hoping for a bounce off of here, but we'll have to see how this week pans out and see if the market further deteriorates, and then we finally get into the yellow zone and get much more cautious from where we are now. So this is a key week for us. So let's talk about the events that came out this past week and what that might signify to us. So as was anticipated on Wednesday, the 16th, short-term rates did go up. You're looking at a chart that shows the projection for the Fed and how they could possibly increase the federal funds rate or these short-term interest rates from where they are to possibly over the next year into 3 years, where they could go as high as about 3.5 is what they are projecting over the next about 3 years into 2018. So this is a PDF that came out from that meeting, and here's that projection on short-term interest rates, the federal funds rate. So for next year, 2016, they are projecting that they will raise rates about a full point over the whole year, but they said they will be very cautious, very slow and steady in doing that. Other projections that might be important to you, inflation longer term is projected to stay somewhere around 2%. Unemployment, although it might increase a bit, they are projecting that to stay at a very low, about 4.9, under 5, and real GDP growth somewhere around 2. They did mention that the slow rate of growth for GDP, and that's one of the reasons why they anticipate being slow and steady on their rate increases. We talked last week about the impact of of oil prices. Here's the good side of that. This is the national average price of gas. Notice it is at just now peaking below $2, and we haven't seen those prices that good going back to March of 2009. So this is the good side of oil going down. Hopefully that becomes some type of boon for the economy, for especially sectors like transportation that use oil and that type of thing. At this point, I'll go ahead and turn it over to Adam, and he'll talk to you about the impact on the stock market from some of the things that happened this past week.
Thank you, Gary, for that great update on the economy and what happened this last week with interest rates and the Federal Reserve meeting. We'll now take a look at the stock market and how it responded to that meeting. So you can see here's the day of that meeting. The market was kind of down on a downtrend, kind of flattened out, moved back up, and then here's the announcement right there. Boom, down the market goes. Oftentimes the first move after an announcement is a knee-jerk reaction and things reverse, and that's exactly what happened. So down it came, market moved back up, but then as people began to digest this news, which was really expected, the market started to move down. You can see as it was moving down, 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 Janet Yellen comes to the rescue. As soon as she steps into the microphone, she begins soothing the markets, talking about this is going to be something we'll do over a long period of time, not a lot going to change here. The market liked that, responded nicely to it, and up we went and finished the day almost 1.5% up on the day. Where did that put us? Let's take a step back now and look at it from a little further back. So here's that day right here. Okay, you can see how it came down, up, down. I'm sorry, that's not the day. Let's move back. Back here's the day. You can see there's the announcement. There's where it came down. It ran up nicely. And here's the following day. Well, looks like a sell the news. The following day, once it was digested, down the market came, kind of flattened out a bit, and then down more near the close. And the following day, more selling. An ugly, ugly down day. Finished, look at this move. It was just a really ugly move all the way down to this resistance area here. You'll notice that then this most recent day we bounced off of that, came back and tested it, couldn't get to a new high, tested it again, and then we actually finished today on an up note. And so it finished near where it had started the day, and certainly much better than where it finished yesterday. So this could be a positive sign here that we held these three points right here. Let's see where they relate to if we step back even a little further. Stepping back a little further, here's where we are right here. So we got right back up to this resistance line, which also corresponds to this area here, but especially to right here where the market bounced. Old support becomes new resistance when it's penetrated, which is what happened here. And so now it's got to get through this level in order for us to move back up. Taking a step back and looking at where we've been, we had a high all the way back in July. And then a lower high, marginally higher, and then a lower high, lower high, lower high. We've also seen lower low, lower low. So you can see the market trending here. It's not really the direction we'd like to see it moving. It's trending downwards. It did bounce here after that big sell-off yesterday. Will this be the beginning of something that could hold? We do have some support right here. So pretty good support right in here. So we're really trading in this range right now, and we'll see which way we break. This is why we're right on the edge of the green, because if it can break through here, then we're going to be in great shape, at least until we get up into this area. Otherwise, we've got a pretty good down drop until we get to new support. So we'll be watching this very carefully. The last time our model had us right on the edge of the yellow and the green, it was slightly in the green, and it worked out, and we caught this nice rally. I'm not so sure we'll be as lucky this time. So let's look at a few other things. Notice the big volume here. Very high volume on Friday. Usually, if you have very high volume associated with a sharp move, it marks the end of a move. So they call that an exhaustion move. So we've got this big volume day on this down day that we had on Friday. That could be exhaustion, and so that's why we might see this bounce. So this may be able to bounce further. Let's look at a prior day with high volume like this. It was right back here. That also came after a run up, but you'll notice the market did bounce the next day, and then it weakened again. Here, however, on this high volume day, you can see that the market came down all the way down to here and then finished right there, and then the next day it tested that spot again. So the high volume did mark a low point where the market was able to rally off of that point and even hold it at a later point. So the question is, are we going to see a move like on this high volume day where the market did in fact wash out and had a chance to run for a bit? Or is it going to be more like this one where the market came back down? So that's the spot we're in right now. From a technical standpoint, we're still in a bull market, but we're definitely moving the wrong direction right now. Maybe we'll hold here. We'll see. If we look at the full year now, you'll notice the Dow is down almost 4% for the year. S&P 500 is down 2.5%. The NASDAQ composite still positive at 3.9. Crude oil, Gary talked about oil down 32.5%. And some stocks were just decimated far worse than that because there was some leverage associated with the oil that they had acquired. Gold also down over 10% year to date. And with the move recently of interest rates moving up on this 25 basis point increase, that strengthens the dollar, which is bad for gold and bad for oil. And so we could continue to see these things slide. We'll see where things go from here. Interestingly, we talked previously at our Breakfast Club meeting, if you attended that, about the NASDAQ 100. That is a subset of the NASDAQ composite that represents 100 of the biggest companies in that index. If we take out the 5 best performing, this number actually becomes a negative for the year. And so that means the market is narrowing here. A narrowing market coupled with a decline and lower lows and lower highs, that does not look positive going forward. Now, one other interesting thing is this has been a really tough year for investing, and particularly for calling direction. It's been a very choppy year. You look at some of the hedge funds have lost huge amounts of money this year. Warren Buffett, his company Berkshire Hathaway, down almost 13% this year. And he's a pretty shrewd guy, so he's had a tough time as well. The other thing is this year was supposed to be a year where the market could move up because oil was so cheap. The idea was that people would get out and shop. The money they were saving from not having to put it in their gas tank, they could be making purchases. That just hasn't materialized. And we've been running in an up market for almost 7 years. So it is due for a rest, due for some consolidation. Earnings haven't been coming in positive now for almost a year, and yet the market's been moving up. Why? Because the Federal Reserve has been the only game in town. They've basically controlled everything. Interest rates, what are they going to do? Well, they finally made their move, and the market is now responding in a way that's not so positive just yet. Now, what have bonds done? Well, you'll notice the Federal Reserve, they raised rates a quarter percent interest rate, but 2-year treasuries and 10 years have barely budged. Okay? Why is that? Because short-term rates, when they're raised, slows down inflation. It slows down the economy. Inflation is the big enemy of longer-term bonds. And so you've seen a lesser impact on 10-year and longer-term treasuries. Okay? It'll be interesting to see how this plays out as we get more news on interest rates. The other thing that's kind of puzzling here is that the strongest sector at this point is consumer staples. That's the only chart that's showing a bullish pattern right now out of the various sectors, the main sectors. And that's a sector that's defensive. So again, that doesn't bode well. And it also seems counterintuitive because the dollar, when it goes up, it hurts multinational companies, and a lot of the consumer staples are multinational companies. So it's a very interesting dynamic that we're having right now. So where does this leave us on our allocations for our core ETF model? Glad you asked. So the core ETF model, we are still just above the yellow zone. And again, as I mentioned, we're right testing that. We'll see where we are next week. But for right now, it's got us positive. In the past, when we broke through and almost went and we're in the red zone for a short amount of time, we finished in the yellow zone, so we stayed invested and then got invested even more. So these indicators have worked well in the most recent past. We'll see if it's right this time. If not, next time this week when we're talking, if we're somewhere in between here or even below the red zone, then we'll have made a change to our portfolios and be recommending a change. So as it stands right now, we are still in the green risk-on zone. It means if you're in a growth model, you're 100% invested in stocks. If you're in the moderate model, you're 80%. I'm sorry, if you're in the moderate model, you're 80%. If you're in the conservative model, you're 60%, and 40% in the defensive, which is mainly cash and treasuries. So a lot of those short-term treasuries and mid-term treasuries is what we have in the defensive area right now. So lastly, we also have a sector rotation model. Sector rotation model is in cash right now. That model only stays invested in the market in the various strongest sectors when we're above the 200-day moving average, which the market is not, and when we have at least 5 positive sectors. Right now we have only 3 positive sectors, and when I say positive, that's sectors that have a positive return in the last 6 months. The S&P 500 itself is down about 4% in the last 6 months. So, as I mentioned earlier, the only positive sector from a charting standpoint that's got a bullish chart is staples. All the other sectors have distribution or downward-looking charts, and again, only 3 of them are in the positive. So our sector model is completely in cash right now. Our market leaders model is mostly invested because we're looking for market leaders, and it tends to stay more invested. Lastly, just have a look at our disclosures here. As always, we've been talking about things in general terms. No, we're not making any specific stock recommendations through this presentation. For those types of discussions, please meet with us one-on-one, and we'd be happy to discuss more your personal situation. Thank you for listening, and have a very Merry Christmas. And if we don't talk to you before the New Year, a Happy New Year as well.